Hello, everybody. Thanks for joining us again on a new topic on our quest for financial freedom. Today, we're going to talk about taxes. Everyone's favorite, right? First, a quick review of our goals and how to get there. If this is the first time you are seeing these next two slides, I'll refer you back to lecture number 1, where I talk about them in more detail. For us today, they're just reminders and place markers in the full curriculum. You can see here that we are past the halfway mark on our journey. Thanks for spending your valuable time with me. Now, on to taxes. Benjamin Franklin said it best. In this world, nothing can be said to be certain except death and taxes. Yes, taxes are an inevitable part of living in a communal society. They're not bad by definition, although sometimes I think we lose sight of that. Think of all the things that make your lives better that are paid for or subsidized by taxes. Roads, bridges, public safety personnel like the police and firefighters, public education, healthcare, etc. The list is long. You shouldn't feel angry about paying taxes. We all have a part to play in the success of our community and nation. Some of that is pitching in a portion of our money to help pay for things that everyone can benefit from. All that being said, sometimes it can feel like we are paying more than our share, or that the money is being wasted on things that we may not value as much. I won't get into the politics. My intention is to explain a little bit about how the tax code works and to help you understand what available and legal options exist to avoid paying more than you have to. Again, we are talking basics here. There are many informational sources that talk about nuances and strategies for paying fewer taxes. That's not my purpose. I want you to understand the things that should apply to everyone without paying for a tax strategist or starting your own business. First, this is not an exhaustive list, but it shows the common areas where the government takes a piece of our pie. When and how are these taxes paid? Well, income tax is generally withheld from your paycheck for both federal and state governments. The amount that is withheld is somewhat up to you based on how many dependents you designate to your employer. The more dependents that you claim, the less tax is withheld. You can claim however many you want for withholding purposes to balance out your taxes come tax time. But if not enough is withheld, you'll end up with a big tax bill on April 15th of the following year, and even the potential for tax penalties if it is grossly underpaid throughout the year. The safest strategy is to withhold just enough to pay your taxes without getting a big refund or a big tax bill. Remember that even though a refund feels good at the time, it's like giving an interest-free loan of your money to the government for the year. Wouldn't it be better for you to keep that money and use it for yourself, or better yet, invest it? FICA tax is what we pay into the government entitlement programs like Social Security and Medicare. It's also withheld from your paychecks. Property taxes are from state and local governments and are paid on a yearly basis, although most of us pay toward the bill every month when we pay our mortgage. This goes into an escrow account, and then your mortgage company pays the taxes for you when they are due. Payroll tax is paid by employers, but if you are self-employed, you must pay this for yourself and your employees, so be aware of the rules. Sales tax is added to all the little purchases that we make on a daily basis and covers a whole host of government projects. Add it all up and it can be a significant part of your income, especially if you're in a high tax bracket. This brings up something that I think is important for everyone to understand. Income tax in the US is a marginal tax system. That means that not all of your income dollars are taxed the same at the same rate. This slide should help out in understanding that concept. Think of each tax bracket as a bucket. The first bucket is for all the taxable income from your Form 1040 between $0 and $22,000 if you're married filing jointly. On that income, you pay 10% to the federal government. If your taxable income is between $22,001 and $89,450, you are taxed 12% of everything in that bucket. You still only pay 10% on the money in the less than $22,000 bucket. Carrying on, if your taxable income is between $89,451 and $190,750, you owe 22% on the income in that bucket, but 12% on the income in the previous bucket and 10% on the income in the first bucket, and so on. Each filing status has its own tax bracket. So if you're single, the numbers will be different, but the concept is the same. With each step up in bracket, you pay a higher percentage of the income in that bucket and in that bucket only. So the highest income earners, over $693,751 per year, pay the highest income rate, currently 37%, but only on the income that falls in that biggest bucket, not on everything. Understanding this concept comes in handy for efficient tax planning, because sometimes we create strategies that fill up a particular tax bracket bucket without pushing into the next one, like how much to convert from a traditional IRA to a Roth in a given year is an example of this kind of planning. Next, let's look at the income tax formula to understand where there are opportunities to save on taxes. You've all probably filled out an income tax form or had someone fill it out for you, right? The basic form is the 1040. This is like the summary page of all the other little forms that might be part of your complete tax report. I won't go into any details of those other forms. Understanding all that can be pretty overwhelming if you're not an accountant. But I do think you should understand the 1040. This slide shows the basic formula and shows opportunities for deductions. We'll cover a few of these opportunities in subsequent slides. Starting at the top, we have our income. This is everywhere that we get money. So salaries, tips, wages, investment income, gifts, inheritance, everything. From that, we can deduct some things that the federal government doesn't tax us on. After applying these exclusions, we have our gross income. From that, we can subtract certain deductions. I'll describe some of these exclusions and deductions later, but hang in there with me for now. This results in our adjusted gross income. This is an important number and is what a lot of various tax rules are based on. It's also affectionately referred to as the line. Any deductions that come out before you get to AGI are called above the line deductions, or deductions for AGI. Any deductions that come out after AGI are called below the line deductions, or from AGI. After AGI, we can take out some more deductions and get to taxable income. This is what determines our tax rate in the tables that I mentioned previously. We do our marginal tax calculations, the tax rates from each tax bucket, and come up with our gross tax. From here, there are opportunities to lower taxes further by applying tax credits, which we'll talk more about in a bit. At last, we have our final tax due. This is what you owe. Now you should have already paid most of that throughout the year, or may have applied some from last year's to this year's bill. So that is all added up. If you're still short, you will owe the difference. If you overpaid, you get a refund. That's how it works. All right, so let's dive into some details. First, what are some of the common income exclusions? These are the money sources that are not counted in gross income and are not taxed by the federal government. I'll read through the list. Many of them may be applicable to you. There are others that are not on this list, so be sure to read through your tax forms, find details at some point to see if you qualify for any of the more esoteric ones. If so, you don't pay taxes on them, so that's great news. Municipal bond interest. This is if you have purchased a bond from a local or state government. The federal government encourages that investment and won't tax you on the interest. Gifts and inheritance are not taxed to the recipient. They may be taxed to the giver depending on the amount and the value of the giver's estate. Scholarship money, no tax. If you sell your house, you don't have to pay tax on the appreciation up to $250,000 if you're single and $500,000 if you're married. There are some rules that apply, like you have to have lived in the house for at least 2 of the previous 5 years. So if you're selling a house, be sure that you understand those rules. Government money that you may be given to adopt a child is not taxed. Death benefits from life insurance policies are not taxed if you're the recipient. If you're the owner of the policy, you're dead, so it doesn't matter. Public Service Loan Forgiveness, PSLF, is not taxed. Most people don't realize that when a loan is forgiven, the amount forgiven is counted as income for tax purposes, even if you never see that cash. PSLF is an exception and very applicable to many young doctors. not taxed. If you get money from a former spouse in the way of child support or alimony, this is no longer taxed as long as the divorce happened after December 31st, 2018. Anything before that followed different rules and is actually counted as income. Okay, now we are at gross income. From gross income, there are many potential exclusions. Remember, these are above the line exclusions for AGI, since we haven't hit AGI yet. I tried to list the most common and applicable ones for doctors. Health savings account contributions are excluded here as long as you made the contribution yourself and did not have it taken out of your paycheck. If it's taken out of your paycheck, it's with pre-tax dollars and accounted for by your company. If you're self-employed, you're both the business owner and the employee, so you have to pay tax wearing both hats. This seems like doubling up. Well, this exclusion is how it evens things out. You can deduct the employer portion. Retirement account contributions are also deducted here if you made them yourself through your own business retirement plan, like a solo 401k or a SEP IRA. If you are employed, the employer accounts for this. Same with health insurance premiums if you are self-employed or have to pay it yourself. Traditional IRA contributions are deducted here, but there are phase-out limits on the amount that can be deducted based on your income. We'll talk more about that in the retirement lecture. Here's another important one. Student loan interest up to $2,500. Many doctors can apply that deduction. If you paid alimony to a former spouse and were divorced before January 1st, 2019, you can deduct those payments. Alimony for divorces after that is not deductible. There are many other deductions, most of which are directed to specific categories of people, like educators or government officials or military personnel. If you're in those groups, look them up. It might save you a few dollars. Okay, now we have our adjusted gross income, the line. From here, there are really two options. Take the standard deduction or itemize. The standard deduction is for everybody and is a set number. In 2024, it is $14,600 if you are single and $29,200 if you're married. That was raised by quite a bit in 2017 as part of the Tax Cut and Jobs Act. And now a lot more people use the standard deduction than before. Option number 2 is to itemize your deductions. This means that you list out each deduction individually from the options and figure out how much applies to you. I list the itemized deductions on the slide, but there are really 4 to consider since it makes up the bulk of the deduction and are applicable to a larger swath of the population. They are medical deductions, state and local taxes, known as SALT taxes, mortgage interest, and charitable gifts. Within those, there are rules. For example, you can only deduct medical expenses that are more than 7.5% of your AGI. For example, if your AGI is $100,000 and your medical expenses for the year are $5,000, they're not deductible because it's less than 7.5% of your AGI, which would be $7,500. If your medical expenses are $10,000, you can deduct $2,500, which is $10,000 minus 7.5% of your AGI. SALT taxes have a deduction limit of $10,000 per year. So if you are in an area with high property taxes, your total tax bill might exceed that number, but you can only deduct $10,000 of it. Mortgage interest of your primary home and secondary home is deductible. This is one of the advantages of owning your own home. Finally, charitable contributions are deductible, but again are subject to rules depending on the charity and the max limits based on your AGI. So should I itemize or should I use the standard deduction? This is an easy question to answer. You do whichever amounts to a higher deduction. Chances are that unless you are super charitable or have a ton of medical expenses, you won't itemize unless you own your own home. Homeowners will have a lot of mortgage interest and SALT taxes that will probably push you over the standard deduction. Otherwise, most likely the standard deduction will be higher and easier since you don't have to document anything. Okay, now, after applying the standard or itemized deductions to AGI, we get our taxable income. But we aren't done. There are still some options to save tax money. I'm talking about tax credits. In fact, if you qualify for any of these, they're even better than a tax deduction because it's a dollar for dollar reduction of your tax bill, as opposed to a deduction, which just lowers your taxable income. So your tax savings is based on your tax rate percentage of that dollar. The problem is that for doctors outside of residency, at least, your income will make you ineligible for pretty much all of these credits. Yes, most tax credits are for individuals below a certain income level, so be sure that you understand the rules for each one. A refundable credit means that if the credit brings your tax bill to below zero, you get a refund for the rest. Non-refundable means that it can drop your tax owed to zero, but not below. I've listed the common credits here, but since most doctors don't qualify for them, I'm not going to go into detail. But you should look into them if you're still in medical school or residency, because chances are you can use some of them. The most common one that people use is the child tax credit. This is a partially refundable credit applied for each child or dependent of $2,000 per child. It has quite a large income cushion to be able to use this credit of $400,000 or less for married filing jointly and $200,000 or less for other taxpayers. So many of you can use this credit if you have kids. Another child-related credit is the Child and Dependent Care Credit, which helps offset the cost of childcare to allow taxpayers to go to work. The credit is based on a percentage of the expenses you pay, up to $3,000 for one dependent and $6,000 for two or more. If you're married, both spouses must have earned income, and the percentage that you can claim for a credit phases out from 35% at $15,000 of income down to 20% for anything over $43,000 per year. Finally, there are two education credits that are worth talking about: the Lifetime Learning Credit and the American Opportunity Credit. These are both designed to help encourage post-secondary education, but have nuances that are important, and both have income phase-outs up to a max of $90,000 for single taxpayers and $180,000 for married filing jointly. The LLC is a credit that can be taken once per year per tax return of up to $2,000 for qualified educational expenses. This can be applied to anyone taking post-secondary courses, including undergraduate, graduate, and professional certification courses. And you don't have to be pursuing a degree to claim it. The AOC is for undergraduate students only and is up to $2,500 per year per eligible student, claimed on the parents' tax returns and not limited to one per return. Students must be pursuing a degree and can only be claimed for 4 years. Okay, that's all for credits. If you have a relatively low income, it's worth looking up a list of all the available credits and see if any apply to you. It can really help you with taxes and can even put money into your pocket if they are refundable. The final slide is a summary of basic tax strategy tools. First on the list is to use the correct and most advantageous filing for your situation. Most common are single filers and married filing jointly. If you are married, it's almost always to your advantage to file jointly. Married filing separately is an option and may be useful in a limited number of situations, mostly related to student loan income-based repayments. But MFJ almost always is better. There are other categories, including head of household and qualified widower, that can save taxes over single filers, but have specific qualifications to know about. Most of you won't qualify for these. Next, understand and apply the exclusions and deductions that are above the AGI line. Be sure to let your tax preparer know about anything that you qualify for. Third, decide if you are taking the standard deduction or if you are itemizing. Do whatever gives you the largest deduction. If you itemize, be sure that you maintain good records. Fourth, if you qualify for any credits, usually lower income level filers, use them. They're dollar for dollar the best tax savings, but also come with many qualifying rules and restrictions that you need to understand. Fifth, if you're self-employed or an owner of a small business, there are many more ways to save on taxes by deducting expenses through your business. This goes beyond the scope of this lecture, but if you're in this situation, it's well worth discussing opportunities with a financial planner, accountant, or tax strategist. Finally, When you're first starting out in your career, your taxes will be quite straightforward, and you can probably do them yourself with the help of one of the many online tax software options, many of which are free or low cost. But as your career advances, you become a business owner or your income and assets grow, your taxes will become quite complicated. I think it's well worth it to get professional help. They can usually find ways to save you money on your tax bill, and if nothing else, will help protect you from an audit or represent you if you are audited. That helps me sleep better. Yes, we made it through taxes. I understand how that word makes your skin crawl, but I hope that this lecture has helped you at least better understand the tax formula and where there are opportunities for all of us to not pay more than we have to. If you do pay a lot of taxes, remember it's because you make a lot of money. So be thankful that you are in the relatively small group of people who can gripe about your high tax rate. You are privileged. Thanks again for listening today. Please hit like and subscribe for me if you would, and tell your friends and colleagues about the channel. See you next time.